Okay, Jay, live on YouTube whenever you're ready.
Okay, thank you. Do apologise for the lateness of the start. Can I welcome you to this virtual meeting of the Teesside Pension Fund Committee? Can I remind all participants that normal rules and procedures apply? For example, comments and questions need to be directed through the chair. If we're meeting virtually, proceedings may take slightly longer, so your patience is appreciated. As per virtual meeting procedures, if questions have been received prior to the meeting, I will call on the relevant member at the appropriate time to raise that question. Invited to speak, please state your name and be as specific as possible about which issue you are speaking to. When members of the public can view this meeting via YouTube Live, they will not be able to actively participate or comment on proceedings. As this meeting is being live streamed, can I remind all participants that their conduct should reflect this. Okay, do we have any apologies for absence?
Yes, Chair. I've got apologies from Councillors Bell, Polano and Wilson, and Councillor Nightingale may join the meeting later if he's able. Otherwise, he's also submitting apologies.
Yes, it's a pity about Councillor Wilson can't be here because he was a new member. I was going to welcome him, but we also have, I think we have Julie Flores with us today, I think.
Hi, yes, Chair,
Yes.
that's me, yeah.
Yeah, and you're Director of Finance and Commercial Development at Teesside University.
That's right, Chair.
So it's nice to have you on the committee, and I look forward to having an input from you. Thank you very much.
Thanks a lot.
Okay, do we have any declarations of interest? Julia, yeah, 1 or 2. That's fine. Okay, and Brian as well, yes. Minutes of the previous meeting.
Unmade, Chair.
Oh, sorry, yes, fine.
Thank
I
you.
missed you. Yeah. Minutes of the previous meeting. Have we read the minutes? Do we have a proposal that they were true and correct record? Julia, fine. Okay, are we happy with that? Seconded, yeah. Okay. Right. The first bit is investment activity report, transactions and midterm. Nick, over to you.
Thank you, Chair. As members will recall, this is the standard report to explain what we've been doing in terms of investing the fund over the last 3 months, over the 3 months to the end of September. As the report states, the fund continues to favour growth assets over protection assets. So eventually we will change that stance, but at present we believe that growth assets are more favourable. We don't have any investments in bonds at this time, and at the end of September 2021, we had cash levels of 11.03% in the fund, and later in the report we explain that that's equal to £534.7 million. So it's an increase in the cash allocation of about 145 million since the last quarter. Mainly that's to do with the fact that we've been reducing our equity allocation in order to get it closer to the strategic asset target of 55%. We over the course of the quarter, we've got the equity allocation down to 71% of the fund, which is significantly below the sort of high levels of 75, 76, 77% we'd had earlier in the year. The committee will recall we've got a target to get down to around 65% as an interim target by the end of March next year. Now, clearly, we don't want to retain an enormous amount of cash for a long period. This is very much an interim position, particularly with inflation picking up, as you will have seen. Members perhaps will have noticed that it's gone above 5%. Was announced today. So, but for the time being, cash is having significant cash allocation is something we're comfortable with because of the reduction in risk that it offers us and the opportunities it provides to invest. And also, we do need cash to allocate to our alternatives investments, which have been progressing over the course of the months and years. And if, in fact, I would draw members' attention to paragraph, sorry, just bear with me, 8.7, which refers to the alternatives commitments that the fund has made. So this is in private equity, in infrastructure and other alternatives that aren't listed. And they were approaching over $1 billion, 1.1 billion we have committed, and actually invested over $500 million. So that's a significant allocation, and that will continue as we move towards our targets in those areas. So I didn't have any other comments to make on the report. I'm happy to take any questions if there are any.
Do you have any questions for Nick on that report? Don't see any hands. Nope. Everybody must be happy with the report. Just looking through it, I mean, I know we're getting towards that that target, but we're still. That's a lot of money to have in as cash, but I suppose it's safe as cash as well.
Yeah, yes, Chair. It's also notable that the value of the fund is higher than it's ever been. Higher than it's ever been at the end of September. It's approaching $5 billion. So, although we do have a lot of cash, that still represents only 11% of the fund.
Okay. Thank you for that. If there's no questions on that, we'll go to external managers' reports. Nick.
Thank you, Chair. This is our usual report to provide members with the quarterly investment reports in respect of funds invested externally with Border to Coast Pensions Partnership Limited and with State Street Global Advisors. So members will recall the investments we have with State Street are passive. So they track an index that we that across a global investments, global equities, track various indices, and the investments we have with Border to Coast are active equity investments in the main. And the performance of those funds are sort of highlighted in 4.1. And basically, the performance has been as we would expect it. So, in other words, Border to Coast is broadly meeting its target. Its target is to get 1% above its benchmarks, and roughly over the period that we've invested, it's managed to achieve that. State Street, as a passive manager, its target is to track the indices that it tracks, and not surprisingly, it has managed to do that. So we're getting the sort of performance that we would expect from both Border to Coast and State Street. I guess the exception at the moment for Border to Coast is the emerging markets fund with Border to Coast, where we haven't been invested for very long with that particular in that particular fund. So it's a bit early to say how that is how that's going, if you like, or whether it's meeting its targets. But I don't have any particular concerns about that at present. And the rest of the report, there's within the report, it reminds members of, in paragraph 5 onwards, about the changes to State Street's benchmarks that happened about a year ago now, which were to exclude certain investments, and that was to exclude controversial weapons companies and UN Global Compact violators. So companies that they consider to be violating particular UN Global Compacts, and there's more detail about that in paragraph 5.2. So that was the report is to be for it's for noting. So if there's any questions, I'm quite happy to take them.
Any questions for Nick on that? No.
Can see.
Oh
Yeah,
yes, yes, I see.
Brian's got his
Yes,
hand up.
Brian. So you got Brian. I didn't see you there.
No, that's fine. You seemed a bit sort of like hesitant when you were talking about Border to Coast meeting their targets. What was that about? Because obviously, they've grown and they've expanded massively since they first took. Well, we started them, and I was just wondering, is their scale starting to hamper their investments?
No, I haven't got any concerns at all about that, and the hesitancy was probably me failing to find the page rather than anything else.
Right. Okay. That's
no,
fine.
I haven't got any concerns. The one where it's a little too early to say, it's perhaps too early to say on all these investments because Border to Coast have only been going for three or 4 years. But our investment in the overseas, in the emerging markets fund, is even shorter term than that. So we haven't got a very long track record to judge it on. But I don't have any concerns at all about the way they're operating or about the fact that they're able to act and operate at scale. That's absolutely fine.
Okay.
Okay, any other questions? Don't see any more. Oh, no. I think 5.2 is very important, the 10 principles of the United Nations Global Compact. Just looking at those, they're the fundamental rights, so is most important. Okay, if that's not talking about Border Coast, the next item on the agenda is Andy Stone from Border the Coast. Welcome, Andy. Would you care to give your report?
Thank you, Chair. Usual question first, if I may. How long do you want from me? Happy to squeeze it into any shape or size.
Not really. Well, there's no real constraint, but if you can get it over with, what, 10 minutes, something like that? 15 minutes? Yeah,
that's no problem whatsoever. Let me just see if I can share the screen. Thank you. And also, just worth noting that I had my COVID booster yesterday, and though I don't feel particularly bad, I don't feel particularly good either. So if I'm a little pasty-faced and flat, A, you might not notice a difference, but B, apologies in advance for that. I'll do my best. Right, so bear with me 1 second. Hopefully that's come up on screen. So I was going to run you through a few different things today. Some of which overlaps a little bit with other areas of the agenda, so I won't outstay my welcome there. So we're going to give you an update on progress at Border to Coast, update you on your existing investments as well, both in equity space and in alternatives, and also briefly touch upon responsible investment policies before that appears later on the agenda today. Of course, feel free to ask questions as I go through this. So in terms of progress, first of all, this is just a bit of a highlights reel for the past 6 months. We have launched a multi-asset credit fund. It's possibly one I understand Teesside may consider allocating to in future. So that's one of the biggest funds that we've got out of the starting blocks to date, almost £4 billion across the other 10 partner funds of Border to Coast. And indications are that the transition activity went quite well as well, which will all be tied up later this month. We have also established our very first climate change policy. Previously, this lived within our responsible investment policy, but obviously, given the gravity of the situation, the year we've had with COP24, etc., it felt absolutely appropriate to develop something as a standalone policy to address the issues that are involved on that front. If you do want to dig into it, the whole thing can be found on our website, and I think it might be included in the meeting pack later as well. Similar, our responsible investment policy and voting guidelines. I won't touch upon this too much here because I've got a couple of slides later on. And we've also been doing a lot of design work and planning for future upcoming launches as well, which can be, I think, seen quite clearly amongst a lot of information on the page I'm showing now. So essentially, this is a high-level plan that we've come up with partner funds regarding their needs, and it's also been ratified by the Border to Coast board and the joint committee of the various chairs. I know there's a lot of information on here. The pale blue boxes are essentially those capabilities that we've got a launch plan in place for. The orange ones are expected to become future projects, some more certain than others at this stage. Series 2 of our alternatives capabilities is one that all of our partner funds, including Teesside, are expected to allocate to. We also understand that the likes of real estate may also be of interest to Teesside, and there's a variety of further capabilities, externally managed equity funds, plus a host of other wider capabilities that we believe will become increasingly important as polling progresses. So Team updates. You may or may not be aware of some of this already, but we wanted to be as open and upfront as possible and give you the opportunity to ask any questions. Our Chief Investment Officer, Daniel Booth, is leaving Border to Coast in the next month or so. He's taking a role with some more day-to-day involvement in the investment process, which I guess as you become Chief Investment Officer of a firm with 50 people under you on the investment side, you do less and less at the coalface in terms of investment, which is very much, I think, Daniel's first love. But he's done a great job. He's built out a very strong team. We've gone from probably about 10 on the investment side on day one to about 50 now. And we've got some very strong people in there across the board. And we're also lucky that we've got John Harrison to step in again as our interim Chief Investment Officer, which is a role that he actually fulfilled before Daniel's appointment. John had the reins for like the first 12, 18 months of Border to Coast existence, and he stayed involved with us as an advisor ever since. You can see some of John's credentials on screen, as well as having a lot of LGPS experience. He was also the Chief Investment Officer for UBS in the UK, which is quite a heralded post. Unfortunately, we also lost Tim Sankey. He'll be leaving us again in the coming weeks. Tim was a head of real estate who'd been with us around, I think, a year. Now, Tim has always been based in Surrey in the southeast of England, of course, and he's found an opportunity closer to home. So we'll go out and start advertising for Tim's replacement in January. We're not expecting this to upset our progress too much on the real estate side. We're still looking to develop 2 global real estate funds by the end of next year. And Tim's involvement in that was perhaps more limited than Paul Campbell's, ex of Teesside, of course, who is very much taking the reins on the global side. And we'll also continue to develop the nuts and bolts, some of the more administrative and operational side of the UK real estate project, while we look to bring in a new head of real estate. I'm happy to pause for a moment there just to see if there's any questions. I'm conscious there's a few things that we threw in there.
Does anybody have any questions there? I can only see a few screens.
Yeah.
Yeah.
Can I?
Sorry.
Councillor Furness, is it okay?
Yeah, Councillor Furness, go ahead.
Thank you. It was just about obviously Daniel Booth. I was a bit worried the fact that he was at the conference. I was quite inspired by him, and then to see him leave, I understand that what you said, that he likes to be actually the one making the active investments rather than guiding it. And it's just a shame that we couldn't hold on to someone of his caliber. But yeah, I guess that's the way it is. And if he wants to leave, he can leave. But it's just disappointing, really.
It is. It's a shame to see him go. And he's, Daniel's fantastic. He's got a huge amount of experience, but he's helped us along the way a lot. And he's also very generous with his contact books as well, ever since he came in the door. The amount of name dropping Daniel's able to do in terms of sort of globally renowned investors, but he's genuinely put the team in contact with a lot of great people who help us develop our own intelligence himself, and help to develop relationships with the likes of private market managers and get us in the door there. So we're very grateful for what they've done, but as you say, it is a real shame to lose him.
Thank you. William, you have a comment to make? And you're muted. Still muted.
Right. Try again. Sorry. Just clarification. And your last slide talked about 2 global real estate funds. I don't think that's right. I think it's 1 UK, 1 global. Can you just confirm that to the committee, please?
Yeah, sorry, William. There is a UK offering and a global offering. The global one will be structured in the form of a low risk stripe of variety and a higher risk variety, with which partner funds are able to allocate between the two to get the returns that they're looking for. Sorry, does that make sense?
Yeah, just clearly wanted to make sure that was clear.
Yeah.
Okay.
Clearer.
Yeah. Any other questions? No. Carry on, Andrew.
Thank you. So I'll just quickly move on to your investments with us. This is just the usual everything with Border to Coast in a page. So the 3 equity funds, largely internally managed, that you allocate to with Border to Coast. plus the private markets allocations, that's infrastructure and private equity that you've committed to with Border to Coast as well. I'll just run through a couple of bits on the performance. I know it was touched upon in Nick's session. In terms of the UK listed fund, since inception, which is the far right-hand side graph, the yellow bar does show that we're close to our 1% outperformance target since we started, which is good to see. We have faced headwinds over the course of 2021, though. I think largely this impacted us in the first quarter of the year. The fund, generally speaking, is positioned conservatively. It was launched in the aftermath of Brexit. We've had the pandemic since, so I think that's an understandable approach. But what it does mean is that when the market is going gangbusters, when returns are up 15-20% a year, this is not a fund that's going to outperform that type of market. It's probably going to lag a little bit. But still, it's a good track record since inception, despite the performance over the last year or so. And we have been adding a little bit of risk to the fund since the Brexit picture becomes a little bit clearer. And some of those recent changes have helped to protect performance a little bit. I'll skip over the ESG and carbon bits because that can be picked up, I think, in part 2 of this meeting, where we've got the full reports in there. So a little bit on overseas developed. This has done very well overall. It's had a good quarter, year, 3-year period, and since inception. Performance in all regions has been positives over those periods of time, particularly good in Japan and the Asia Pacific ex-Japan regions. As with the UK fund, markets have benefited from the impact of the COVID vaccine in quarter 3, albeit had a few issues due to supply problems in general causing industrial upset. In terms of our Q3 performance, just a few bits and pieces worth pulling out perhaps. Strong stock selection in Japan and the US, and overweight positions in the likes of tech and energy have benefited the fund there. Like the UK fund, it does have a low risk profile overall. We are actually running a fair bit of risk in the individual regional sleeves. Those are US, Europe, Japan, and Asia Pacific ex-Japan. But when you put them all together, you do get some quite decent correlations, complementarity that reduces the overall risk of the fund. We've touched upon emerging markets already. As Nick said, this is one that has lagged a little bit. It is worth noting, as I've picked up, I think, in the last meeting or 2 that I've attended, that we've restructured the Emerging Market Fund earlier this year. It was purely managed in-house, but it was a big universe for a small fund management team to look after. So what we did is enlist 2 specialist external managers, that's UBS and Fountain Cap, to run the China part of the portfolio and retain an emerging markets ex-China mandate in-house. So we think it's a good approach. It gives us boots on the ground in China, which is a rapidly growing and complicated market. And also bringing in those higher conviction specialists has allowed us to push up the fund's performance objective a little bit. So from 1% above the benchmark, as it was previously, up to 1.5% above the benchmark. As we can see, the fund does have a track record that needs repairing. It was slightly below the benchmark during its period since restructuring earlier in this year, but we are seeing some positive returns from the China managers, particularly Fountain Cap. Fountain Cap have tended to do quite well because they're underweight in some of the larger technology companies that have been hit recently by the Chinese government crackdowns. Just a little bit on private markets. The private equity and infrastructure funds that you invest in with us. We've just included these usual slides as a bit of a recap, just to show the strategies that we're allocating to the different regions as well. The fact that we're targeting a 10% return overall for private equity. And just to give you a reminder of how it works with all private markets, is that our in-house team researches the investment universe and makes commitments to a range of different managers to give diversification. And then what those individual managers do is seek opportunities themselves. And it's only when they find those opportunities that they request cash to be drawn down so that they can deploy it. So it's a 2-stage process, commitment and deployment, which means the portfolio is only build up gradually over time. And what we've been doing is developing this over Series 1 over a 3-year period of time, and we'll be launching Series 2 next year. So just to show you how we're doing on those deployment rates, what we do is we've got a private market specialist advisor called Oldbourne, who provide us with market data for what is typical in terms of deployment rates. For Series 1 overall, we're in a pretty decent position. We're ahead of where the model market average is expected to be. There's no particular headlines worth drawing out on the individual ones though, but it's nice to see we're in the right sort of ballpark. Infrastructure is of course the other one that you're invested to at the moment. Same sort of setup. Benchmark target here is a return of around 8% per annum net of all costs, which is more reflective of the asset class there. And it also, as with private equity, reflects partner funds requirements in terms of risk and return objectives as well. So just in terms of deployment for infrastructure, so overall with the blue line, we're slightly ahead of where the market is. On an individual basis though, we are a little bit behind in Series 1A, which is the first one that we launched. In the case of this one, it's kind of representative of increased competition that the market's seen in the likes of renewable energy opportunities. So oil majors, for example, have been moving quite heavily into offshore wind development and other renewable sources, and that's created a bit of pricing tension. So our managers in this area, particularly one called Macquarie, have been keeping the pricing discipline, taking a little longer to deploy their capital, which we think is the right approach, but it has left them a little bit behind in terms of allocations. I have got a couple of bits on responsible investment here. I fear that my 10 or 15 minute slot is up though, so it might be best if I just make any of the points I was going to make in the later part of the agenda where this pops up if necessary. Happy to take any more questions though.
Okay, any questions? Can't see any. Just one point, Andy, about China. Looking at those figures there, I know when the Board of the Coast, when we had the conference, it was showing we had some 2 China managers on there. How do you see this market going? Because you said the Chinese can just cut you off at any time. Presumably they're still wanting investment because they still want their markets to grow.
Yeah, I mean, it's always the cliche that, and I think it's true because most cliches tend to be, is that emerging markets will always be at riskier end of the market. And the reason it's riskier is because you've got potentially higher return potential there as well. With China, you know, what we've seen is that the government will intervene in certain circumstances rather than taking the more pure free market approach that we used to see in much of the world. It is interesting that I think the timing of some of the changes fits in with the election cycle in China. Apparently, it is not unusual for them to take a more perhaps communist socialist type of view the year before an election, before easing things out a little and helping to develop growth a little more again. I think China's going to be a huge growth story, full stop. It's going to become its own region in terms of separate investment. It's going to become hugely significant, and ergo, you're going to see some significant market cap increases and no doubt the globalization of some of the companies involved there as well. On the flip side of that, you're going to see stories along the way like those that we've seen with technology companies being cracked down on. And we had the private after-school education sector, which basically got turned into a non-profit sector overnight by the government in Q3. So it could be a bumpy ride, but you're expecting it to be a bumpy ride that goes in an upwards direction, I'd say, overall.
I suppose if you have your market spread over quite a few different asset classes and things, you know, if one goes down, the other should go up.
Yeah, that's it. And it's another reason for making sure we've got these local specialists in China as well, and 2 different managers taking slightly different approaches, not having all your eggs in one basket.
Okay, well, I know that the Chinese over the years have had their values going up by way beyond what the rest of the world were, but they can do that, I suppose. Anyway, thank you for that. If there's no other questions.
Chair, I think
So,
Peter Moon would like to ask a
Peter,
question.
I can't see me. Peter, go ahead.
Yeah, no, I'm just a bit confused if the approach in the developed market funds is a cautious one, while the UK is underperforming, but the overseas one is outperforming. I just wondered if you could take us through that bit, Andrew. Thank you.
Yeah, I think, Peter, just a high level, the UK fund is an individual sleeve. It's just one fund run by a couple of different fund managers. And as I say, we've taken that particular approach partly in light of Brexit, just to make sure that we are hedging our bets to an extent and making sure that we're not falling foul of things as they progress on that front. With the Overseas Developed Fund, I suppose just to clarify, you've got 4 individual regional sleeves there that are each run by a different fund manager. So just to recap, it's North America, you've got Europe ex-UK, you've got Japan and Asia Pacific ex-Japan. So each of those is not necessarily run in a low risk manner, but when you put them all together, I think you do get some nice offsetting of risk overall. I think the Overseas Developed is running a slightly more aggressive approach perhaps than the UK fund, but you've got that nice offsetting approach overall. And I think it's worth noting that in all of our funds, we do have a similar approach for the internal management, which tends to be quality driven. So we're focused on companies that have got robust balance sheets, that we believe have got solid cash generation, good quality brands as well, which tends to be a relatively low risk approach. Was I going to mention anything else? I suppose the final point is that overall and over time, because we always wanted it to be a gradual evolution, we've tried to up the active share in each of these portfolios as well. So what that means is effectively taking larger positions in an increasingly smaller number of companies. But that's not something we wanted to shake too much overnight. And we're conscious that the fund managers that we have in place have tended to run these quite prudent approaches, these +1 outperformance targets for local government schemes over the course of most of their career.
Okay. You happy with that, Peter? Any other questions? Okay. Thank you very much for that. In that case, we'll move on to investment advisors reporters. William and Peter, who wants to go first? William? Or Peter?
Okay, now I'll go first. I was just searching for my mute button. I think when I last spoke to this committee, I said that I thought we were approaching a turning point in markets. And broadly, I haven't changed that view. But of course, some things have just developed. First one is that economic growth, which I said was beginning to fade last time, really is slowing down quite quickly. US, Europe, below trend growth. China, actually almost zero growth in the most recent quarter. Japan has fallen by 3% in the last 12 months. And of course, what has happened over the last few weeks with Omicron and COVID and kind of new lockdowns is absolutely not going to help that. I mean, I don't know about you, but I've certainly been to a number of shops and restaurants recently which have just said this is far worse than last time because we're getting no support and no custom. Second major change, which we have already mentioned today, is of course inflation. US is up at 7%. UK today, as Nick said, is up above 5%. And that is, whatever you may think of inflation, and Peter and I have slightly different views, is not a comfortable place to be. Question really is, first question is, what can the authorities do? And the answer is not a great deal. I don't think rates are going to go up by much, if at all, because of the economic situation. The only thing they can really do, which is what they've done in the past when faced with the problem, is to throw money at it. And right now, that's what the US has been doing. And that's one of the other changes from 3 months ago. The US has become appreciably looser in its monetary policy. Interestingly, the rest of the world is actually still remaining quite tight. And in particular, China China, the authorities, they got lots of problems with Evergrande, etc., but they're not responding by just throwing money at the problem. They are tending to keep things quite tight and go for stability. And that's another reason I think we're going to see further lower growth in the world going forward. Now, on inflation, the real question is, are we moving to an environment where kind of inflationary psychology like the 60s, 70s, 80s takes hold again? I think Peter thinks we probably are. I tend at the moment to think we're not, but I do accept that it's the biggest risk we have at the moment. Markets have taken the view that, again, as I said, that the authorities will simply solve the problem by throwing money at it. They may be right, they may be wrong, but my guess is that if they do that, we're going to get more inflation in the future. So it's not an easy place to be at the moment. The fund, as Nick says, still has quite a high weighting in equities. I'm not comfortable with that. On the other hand, there's the old cartoon of the First World War where you've got two squaddies sitting in a flooded hole and saying, if you knows of a better hole, go to it. And it feels a bit like that. There's not much else I want to move money fast into away from equities. Over time, as Nick said, we are diversifying. That's the right thing to do, but it will take time. So I think we just had to slightly sit in our hole for the moment. And it's probably no better place to be. Let me stop there and ask the questions.
Okay, any questions for William? Don't see any. Just a question there, William. You mentioned the American market, etc. I know some of the big American companies, especially the car manufacturers, cancelled all their orders, and now they're reaping the whirlwind for that. How do you see that sort of market coming back? Because they're saying that in the first or the second quarter they should be back online, but a lot of other companies have gone elsewhere to, if they said, well, you don't want our chips, we'll produce other things. So how do you see that in the market? Because it sent the value of used second-hand cars through the roof. So how do you see that recovering? Because the big companies like the Chrysler, the Fords of this world are certainly suffering with their productions.
Yeah. Well, the underlying problem there is the shortage of semiconductor chips, as we know. And I don't see that going away very quickly. So I think there will continue to be supply side problems of that sort. Just again, as an example, in China, the headline inflation rate is still quite a bit lower than the US and the UK. It's about 1.5%. But if you look at the production price inflation, i.e. the inflation at the semiconductors and things like that, it's 13.5%. And you then say, well, why do I think that inflation is going to kind of turn around back again? I do see these as short-term factors, not kind of long-term factors in the most case. And I think they will, over the next 12 months, 2 years, as the world, I hope, normalizes, will come back down again. But will it be the first quarter? I rather doubt it.
Thank you. Any other questions for William? No. William, do you have anything else to say before calling Peter?
Nope, I think that was all. Thank you, Chair.
Okay, Peter?
Well, I think William's basically said it all, and I agree with the majority of it. In fact, in terms of market direction, I think we are at a position where it's going to be very, very difficult for markets to make any positive progress. I mean, the threat of higher interest rates, and I think that is just a threat. I don't think it's going to occur. If it does occur, there'll be very, very minor increases, which won't actually impact on inflation. On inflation much at all. Yes. But let me take a step back. I won't read out my paper because it's quite boring. It said really much what I said last time round. But the world is getting a bit of a dodgier place. It's Ukraine situation with Russia is quite marked, and it's interesting that Putin would take the opportunity to start saber rattling when America, which seemed to have exited the international policeman stage, then revisits it, but in Australia to take on the Chinese threat. I think Putin has assumed that America now has eyes on China and won't do anything about the Russian threat, which I think is probably, I don't know, it might well be right, but it's certainly raised tensions across the world. As far going back to inflation, though, I think it is going to become embedded. I mean, this is where I do differ from William, because there is a huge amount of pent-up demand across the world where people during the pandemic have not been spending the money. They've been putting it away. And now I think this inflation we're seeing is people changing their stance on how confident they feel, and they're starting to spend money. And I think, that means that if the goods aren't there, the prices will go up. Well, the goods aren't there, the delivery drivers aren't there. We've got quite a horrible mismatch in economies across the world, which is going to be quite difficult to rebalance. Markets, though, do not like inflation. There's no denying that, whether it's because the margins get squeezed as inflation takes up and price response is slower, or whether it's because the discount rate on the valuation of equity markets goes up, which even if we don't get short rates moving, we're likely to get long-term rates rising, which makes, again, the fixed interest markets look pretty ugly. In fact, it looks quite tricky for most markets out there. I think I think our equity holdings high, but I think William summed it up quite well. Maybe it is the only game in town. It's a difficult game, but we have made a lot of money out of our equity holdings. We've taken money out at the right time. We've made and built that cash reserve. Now, unless we can find an alternative to that cash reserve, and I know that Nick and Wendy and the whole investment team are looking really hard to find alternatives for it. And, I think my advice is now we've widened the net. We're no longer looking for equity type returns on the private equity side or the alternative side. We're looking for something to beat cash, but there isn't a lot of that out there, to be honest, which looks as safe as cash. So we're in a bit of a cleft stick. I think we just have to sit with those rather large cash piles and hope that the investments we've made in infrastructure and the private equity markets and alternatives as well gets drawn down at a faster rate than it has been up to now. I'm looking at borders to coast here, actually. Gets drawn down at a faster rate than it has been. So that's really where I am in terms of my thinking, Chairman.
Thanks, Peter. Any questions for Peter? Yes, I can see Theo.
Thank you.
Yes,
It's for Peter and William. If you feel inflation could be here for 2-3 years and it could be as high as 5+%, what type of returns would the pension fund have to make just to stay at the 100%, funded?
Well, I think you'd then be looking at returns of about 8% requirement on that, and we're not seeing that from cash, certainly. And I know what your question's really sort of aiming at, and it's I think it's just a difficult one. But we've got quite a big surplus at the moment, quite a big cushion, and what I think the cash is doing is making me feel more comfortable that cushion is at least partially protected, because any equity markets might not fall much. They might not fall at all. I might be totally wrong, but they could fall quite a long way. So having that cash is actually, I think, about as good as we're going to get at the moment, because credit markets aren't really going to go anywhere in that situation. It's difficult to find alternatives rapidly to replace that cash pile.
Obviously, holding cash for too long holds obviously negative returns, isn't it? Obviously, you get no interest and
it's minus 5% real return, and that's assuming that inflation doesn't rise further. I mean, if it becomes embedded, we might get back to. I don't think we will do, because I hope central banks have learnt lessons, but you have to look through history and you say, what lessons have central banks learnt over time? And unfortunately say not a lot, really. I mean, I think the response to the global crisis was actually bang on, but the fact they're still continuing to chuck so much money at the world economy, or have been until very recently, shows that they clearly didn't think inflation would start to rise. And the fact there is so much latent money in the economy, in the world economy, if I can put it that way, means there's no reason why inflationary pressure should slow in the medium term.
So I guess it's just, yeah, cash is the best thing of all possibilities. Because historically, hasn't it been bonds is the way you fight against inflation, but bonds are obviously at all-time low.
Yeah, that's true. But they've got to be at the right price before you go into them. And at the moment, on 1% yields, I suppose I've learned through the passage of time is you don't lend to governments cheaply because they never spend money wisely anyway, or rarely spend it wisely. And here we are in a position where we're lending at them at zero interest rates. So I think we as William said, there aren't many bolt-holes around here to go. So we've got this sort of almost barbell approach of it's either equities, let's get as much as we can into alternatives, or cash.
Yeah. Okay.
And it's uncomfortable, but I think we're in a good position. I said that earlier today to Nick and Wendy, but I think we are in a good position, definitely. Just we don't want to wander it. Sorry, Theo.
I was just saying, we just need to be vigilant then, isn't it? Like, obviously, the markets could change quick, and I guess the cash gives us that liquidity to make decisions quick, or But yeah,
and also it's also our only protection asset, really.
All right, thank you.
William, you want to come back on that?
Yeah.
Yes. I was just going to kind of add a little bit to what Peter said. I mean, I think Councillor Furness put it really well that he said cash gives you freedom of action. The fact equities also have some inflation correlation, and of course, one of our big risks is inflation. They're not directly linked to correlation, but equity dividends should over time rise roughly by inflation, and that's another reason for holding quite a bit of equity at the moment.
Okay. Any other comments from that, Peter? Are you happy with that report?
No, that's it. Thank you.
Great. I don't see any other questions. Nick, you have a question.
Yeah, just a comment really. There is one other asset class that we have got up our sleeve, which is property. Just to segue into the next next section.
Yeah, I didn't want to describe. Sorry, Chairman. I wasn't sure whether I should describe that as a protection asset, but some people do view it as such. But I view it more as an equity. But because it has the characteristics that William has just explained. So yeah, probably not a bad place to be in inflationary times.
Yeah. Depends who your tenant is in a few cases, but there we go. Okay, if we're happy with that, personally, I think that having cash it's the best of two evils in a way. If you've got it there, you can always put it into something, as Theo pointed out. So there we go. It's just something for the future. Thank you, Peter. If there's no other questions for that, we will go on to the CBRE report, which is the next item. Andrew Peacock and Andrew Owen. Andrew, whichever Andrew Peacock.
I'll take it to start, Chair. Thank you very much. Apologies for not being on camera, but my signal is so poor today that I've switched the camera off. So you'll just have to listen to me and not be able to look at me, but I'm sure that's fine for you. Just taking that point about inflation first, actually. Real estate is often quoted as being a good protection asset, as you say, but it really depends on the type of inflation. I think cost plus inflation, which is what we've got at the moment, it doesn't particularly protect you against that. And it's where there's growth and salary, inflation is being created by growth and salary increases, etc. Then it can help that way, but it tends not to help in times of cost push. So not particularly good at this time in the stage in the market. More generally on the markets, I think it's fair to say that over the period since the last meeting, the sectors in terms of logistics, retail, and offices have tended to go in the same direction that they were going previously. So people are still incredibly keen to buy logistics properties, and we've hit another all-time high in terms of the prices that are being paid, and the yields are down at sort of 3.5%, 3.25% now, which is unheard of. The offices remain in a state of sort of dormancy because people are still not sure what's happening. We're all back at home again, and we had a false start going back to the office, but we're back at home again, and people, until that unwinds itself properly, I think offices are going to continue to be a little bit out of favour, and people are just sitting on their hands. The retail market is interesting in that it's fractured into different parts now. So as you'd expect, the supermarkets are still going very strongly in terms of demand because of their characteristics, good covenants, strong companies on the leases, often for long leases, and often with inflation linked kickers along the way. So people like that income stream. So they're trading very well. As are and retail warehousing has actually also come back into favour, and we've seen values in the interest in the retail warehouse market come in by about 150 basis points over the last 6 months. So that overcorrected in the downturn and then has bounced back. The high street remains out of favour, except people are now seeing it as an opportunity to buy the very best pieces of the high street, in the market towns, the Oxfords, the Cambridges, in those locations where the core is very tight, and if you can pick up the assets in those core locations, then they are, because they're still trading at 7.5%, 8% in those areas. So if you can pick those up, but unfortunately the lot sizes are very small and have got smaller, so it's a difficult one for us to justify in terms of the fund. So yeah, more of the same, and very much a flight to quality. People are looking to only buy the best assets, and because that's relatively hard to come by, the prices are getting bid down. So not an easy place to be buying at the moment, and as Peter said, very difficult to buy in these markets at the moment because there's so many people looking for it. So that's general update on the market. If anybody's got any questions or specifics they'd like to question on, then happy to take questions.
Any questions for Andrew there? No, I have one for you. I mean, recently you can see the likes of Amazon, things like that. Any property they deem any size, they just want to buy it. They just throw money at it. Surely that's giving a false premises to the market. It's putting prices up to a point where is it worth investing, because you can't really guarantee to get it. So what's your opinion of that?
Amazon aren't buying those properties. They're leasing those properties in the main. But obviously investors are buying those properties, those large Amazon distribution units on the back of those leases, and they are trading, and they're the ones that are trading at the 3.25% yields. There is a little bit more than Amazon, just Amazon in the market on the leasing side. A lot of the other 3PLs, obviously logistics has gone into overdrive over the last 2 years. So there's no reason to see that that's going to stop to a certain extent until they've totally mapped out all their logistics networks, and there's a little way to go yet. So but you're absolutely right, we can't justify those yields at the moment. We had a long discussion about it at our investment board a couple of days ago, and all the advisors on the board agree that the prime logistics market is just unsustainable in terms of the yields, because you're relying on such high rental growth in the future that it's so uncertain. You're needing the rents to double in over the period to justify those yields, and we just don't see that happening. The tenants will start to have the ability to hold back those rents, and you're not going to get that. You're not going to get the overall total return.
And as long as that continues, the high street will continue to be not the place to invest in that sense.
Unless it's a very prime, I think we all see at the moment, people still enjoy going out and shopping, but it's all of the high streets. There's too much shopping, and it's going to contract into the very much prime areas.
Sorry, there was another comment there. No. Okay. Thanks, Andrew.
Okay.
Yeah.
I think Andrew will
Andrew
pass
Owens
on
next.
and
Yeah.
talk about the portfolio.
Yep. Go on, Andrew.
Morning, Chair. Morning, all. I'll just run through the report that's in the list of documents, as usual. The report is as presented. The report is as presented, other than the following comments. Under investments, page 3, although there were no investment purchases or indeed sales, purchases largely for the reasons that Andrew has eloquently put just a few minutes over the last few minutes. It's a hot market. It's difficult to show a purchase is accretive to the portfolio as we stand. We continue to look, but that's the major issue that we face. However, there is some news to tell you that we introduced or acted as advisor on a real estate loan for the fund. So although this won't sit in the portfolio, it does provide an opportunity to diversify and spend some of the cash. It was a loan of £20 million. It's a 4-year term. The fund have loaned the money to the existing owner of a retail park, a fully let retail park, high quality retail park, which I'd be delighted to buy if I could. Yeah, that completed a couple of weeks ago. So that's quite pleasing. And
Andrew, is it worth just explaining that the loan is at the senior end of the debt stack, so it's a very secure loan and is only in terms of the leverage level?
Yeah, well, it's as Andrew said, it's low in terms of everything we look for the fund. It's low risk, so it's low risk both in terms of LTV. The LTV is about just over 60%. It's low risk in that the park's fully let. The leases are all long-term leases, just under 10 years of unexpired term as an average. The borrower is the existing owner, rather than a new owner coming along with a fancy asset management plan that possibly won't work. They know the asset inside out. It's also replacing an existing debt facility. The existing provider actually thought this was unexciting and dull, and thus wanted to exit. So that's almost a perfect opportunity for us to step in, or the fund to step in, because it is seen as very low risk. So yeah, it reflects all of those qualities. Then moving on to asset management, the asset management update. All of those comments there, those 5 comments, are all remain true. We're making steady progress, I think is the phrase. Harrow Green in particular, the one in the middle there, that is a lease renewal. That tenant has been looking elsewhere in Birmingham for alternative premises as a bit of an empty threat, but we've picked up from the market that they've now withdrawn from all of those discussions and are focused on back to this asset. So they want to make various alterations to the property. They also want the fund to fit a new security fence around the asset, which we're looking at the moment. So all that's progressing well. It's just taking a lot of time. There's quite a lot of detail there. So I would hope to report, if not the next quarter, the one after that one's concluded. But there's quite a bit to do on that one. All good stuff, but it's quite a bit to do. And on the arrears, towards the end, you can see the total collectible arrears as of 3.5 weeks ago was just under 1.9 million. I'm pleased to say that that's reduced now by about 30%. It's a figure as of today of 1.349 million. So that's just over $500,000 of recoverable arrears. And my memory tells me that that's actually the best total it's been for the last 3 or 4 meetings, which is good. In a little bit more detail, just running through that list there, Nuffield, they've continued to pay some of their rent. It's a bit of an odd one, this. They sort of pay a little bit or pay some of it, but not all of it. So their debt is currently 269. That's the biggest one, and that's my new focus, given the news on Sports Direct that I'm about to tell you. Tesco store, the next one, that's all paid up. Libra Textiles, though it sits there as a debt, they're actually on plan. They're on a payment plan, and they're actually on plan. So it's just money that is coming to the fund on an agreed basis. Matalan, that the property manager there has led those discussions with Matalan. It's part of a slightly wider picture. We're just looking at the car park and bits and pieces that they want to talk to, but at least they are talking. Saint-Gobain, they're looking to assign one of their leases, so we'll pick up the arrears at that point. Just before they assign the lease, they'll be required to pay their arrears. Harrow Green, I've just covered off, so we're in renewal discussions. Those arrears will get paid, if not before, when we complete on the renewal. Tough Glaze, that's all paid up. That 77,000 is paid. Shoe Zone, they're just keeping quiet. So it's a smaller one, but we're not making progress on those. They're just sitting behind the current protection scheme. And then finally, Sports Direct. We did talk about this one in the last meeting, and I'm pleased to say that we have made agreement with Sports Direct, and the legal formalities were completing today or this morning. So all those arrears, we've actually got the money in the bank. I was told yesterday the money is with us and will be transferred to the fund, if not today, tomorrow. Chair, that concludes the report. I'll take any questions.
Thank you, Andrew. Good news about Sports Direct. I was expecting to say it was going to be the usual problems, but that sounds very good.
No, we did a deal with them. Yeah, we did pay them. We did let them have some rent free for the period that they're actually closed. That was reasonable. We've been slightly more generous on tenants who've been slightly more easier to deal with. So yeah, it was a good deal all round. It's all clear.
Okay, that's good. Any questions for Andrew? Don't see any hands. No. If not, I'll thank you for the report. It's interesting market. If we can find some other areas to go into, it would be excellent. Thank you.
No problem.
Okay. Next is the risk register. Nick.
Thank you, Chair. This is a report that actually came to the last committee, but unfortunately we weren't quorate, so this is a returning report. This is to advise members of an additional risk that's been added to the pension fund risk register, and to provide members with an opportunity to review the risk register as it stands. The additional risk we've added is climate change, and this is something that was pointed out when we updated the funding strategy statement in June this year. We added an additional risk in relation to climate change and the impacts that would have or could have on the fund's assets and liabilities. So we're now just formally including that within the fund's risk register. As members will be aware, climate change has got the potential to have a wide-ranging impact on all aspects of human society, including economies, trade, the values of companies and financial assets, and it's sensible to include it as a separate standalone risk instead of allowing it to be just covered by existing risks like global financial instability or investment class failure. So there's a full description of the risk, which I won't read out to you, in paragraph 4.4, and the main political sort of potential impacts and consequences of the risk for us as an investor are significant changes to valuations of assets and asset classes. So the potential for some assets owned by some companies to become effectively worthless, or what's known as stranded assets. So the classic example would be oil companies that have got a lot of their valuation based on oil they haven't taken out of the ground. If they're no longer able to take that out of the ground, they're classed as stranded assets, and that could significantly affect the valuation of that company. But there are also opportunities as well arising from climate change, for example, in sectors seen as positively contributing to transition to a low carbon economy. And some of that is some of the investments we make in alternatives, and particularly in infrastructure, pick up on those areas, wind farms and solar farms, etc. So the proposal is to continue to review the risk register and to present it to the committee at least annually. And in relation to climate change risk, the fund's going to continue to work with its advisors and investment managers, including Border to Coast, to better understand our exposure to this risk and how it can be mitigated and how it can potentially take advantage of any opportunities that might arise. So that was it, Chair, unless anyone's got any questions about the additional risk or about the risk register itself.
Any questions for that? Don't see any hands up. No, thanks for that report, Nick. I think that looking at that, and certainly Shell have recently announced that they're going to participate in a field up in Scotland, etc. They're looking at that and moving away. So that's one area. I'm sure someone will want to invest in it, but it's good news that a big company like that are finally taking notice of climate change. Thank you. Board Recursive Report. That's again you, Nick.
Yeah, this is to advise the committee of changes that Board of Coast has recently made to its responsible investment policy and corporate governance and voting guidelines, and to recommend that members note and approve the revised Board of Coast documents that are included. As we've got track changes in appendices B and C of the report. Now, if I get stuck on anything here, handily, I have we've still got Andy from Board of Coast who can help me on any of this stuff. But basically, the report just sets out the fact that legislative requirement is for funds to have a policy on environmental, social, and governance considerations, and it has to take into account selection, non-selection, retention, and realization of assets, and the exercise of rights, including voting rights attached to investments. And what I mean by that is members will be aware that if you own shares in a company, you get to vote in that company, and you have a say in how it operates. And it's important that we explain how we will operate and how we will use our voting rights. But in order to make it practical and consistent for the Board of Coast funds to coordinate this, Board of Coast has developed a responsible investment policy and a corporate governance and voting guidelines document for all of its partner funds to approve, and that's what's included in paragraphs in appendices B and C, and that apply across the investments, all the investments that Board of Coast holds on our behalf. And these documents are reviewed annually. The main changes that have been made this time, or being made, proposed to be made this time round, there's a standalone climate change policy, which is included Appendix A, and it was agreed last year that that would be put in place. This one significant aspect in the climate change policies, it includes specific exclusions. So for the first time, Board of Coast is saying there are certain companies that it will not invest in, and those are companies that make more than 90% or more of their revenue from thermal coal and tar sands. So the idea is basically this type of company, it's not really possible to engage with it in a meaningful way that will benefit the environment, because that is what it's doing is effectively indefensible, if you like, in terms of environmental considerations. So the decision is taken not to invest in any of those companies. I don't think it rules out very many companies, but that's the decision that's been taken. Other aspects of the review process, if I draw members to paragraph 6.7, it talks about the amendments that have been made to the responsible investment policy, which is about wording on diversity and diversity of thought. It's about including real estate as an asset class, because Board of Coast will shortly start managing real estate as well. It intends to. Changing what's included about climate change because of the standalone climate change policy, and explaining about the new engagement themes. And Board of Coast works with a company called Robeco, who is its engagement partner, and it has up until in 2018, it set 3 priority areas for engagement with portfolio companies, and these are governance, diversity, and transparency and disclosure. Over the last few months, Board of Coast has been looking at reviewing those themes, and has worked with partner funds through workshops with the officers group and through the joint committee, which Councillor Coop sits on. And basically it's come up with 4 new themes to focus on, and these are listed from paragraph 7.4 onwards. So these are about low carbon transition, about waste and water management, about social inclusion through labour management, and about diversity of thought. So there's a bit more information in the report itself and within the accompanying documents, but that was all I was going to say, Chair, unless anyone's got any questions. But obviously Board of Coast would very much like the committee to approve these documents, because they will allow it to coordinate its response to responsible investment with the other funds, partner funds in Board of Coast.
Okay, any questions on that? I see 2 questions. Jim, Councillor Beale, and then Councillor Creevy.
Yeah, it's not a question, Chair. But seeing as Board of Coast are here and and they're committed to an annual review of the responsible investment policy. I would just like to put in that regular plea that they look at investment in tobacco products, however complex the market might be. There's there are some funds which have addressed that particular pernicious product being promoted through investing in the companies that produce it, and I'm sure that they'll give it due consideration going forward.
Okay, do you want to come back on that?
Sorry, Chair, me.
Yes, Nick.
Oh,
Or-
it's all right. Andy nearly spoke. Then I'll let Andy
Andy, yes, Andrew, do you want to come back on that?
Yeah. Thank you, Chair. I think it's worth noting that a couple of years ago, and Nick may recall this, we did run an exercise just looking at potentially excluding tobacco companies, as that felt like one of the more obvious and perhaps easy cut and dry cases where there might be perhaps a moral push to deal with an investment as opposed to just a pure investment case. And at the time, the partner funds didn't wish to pursue that. I mean, there are implications for the portfolio and the investment case and proposition overall if we take it out. If there's a push to do it from the partner funds across the board, then that is absolutely something we'd be happy to look at again, I think. And if there are things that you are passionately believe should be excluded from the portfolio, we'll take it into account and could definitely discuss that with all the other stakeholders as well.
Thank you. I know Councillor Beale has over the years been very passionate, and I do agree with him in that sense, because morally it's not the place to invest, but just financially it is at the moment. So just one of those things. Councillor Creevy, you have a question.
Yeah, hi there. I just wanted to double check. Are we approving all 3 appendices then today? Is that what we're being asked for? Because I'm a bit confused by the recommendation.
Nick, would you like to answer that?
Just B and C. Just
B and C.
B and C.
Okay, thank you.
Okay, is there any other questions or comments? Councillor Ostrom, you have a question.
Can I move that we approve the report, Chair? Because there has been criticism recently of local government pension schemes and the way that we are investing in fossil fuels and such like. So I welcome this report, but I do agree with Jim. I do think we need to be looking at tobacco and whether or not we should invest in it. Well, I don't think we should invest in it, basically. Thank you.
Okay. Right, in that case, can we move that we approve the appropriate parts B and C? Julia, you would move that. Councillor Creevy, you'd second that. All in favour? Any against? That's fine. That's been approved, Nick.
That's great, thanks.
Okay.
Thank you,
Wonderful. Is there anything else on that? No. So that's item 11 and 12. If I've not missed anything else out, Government's Policy Review, we've done that. XPS Pension Administration Report. We've got Paul and Graham.
Yeah, thank you, Chair. It's just Paul today.
Okay.
On behalf of XPS.
Hang on, sorry. I think
have I missed? Yes, I have. Sorry, I've missed out the Governance Policy Review. Yeah. Yes, I'm sorry, very sorry about that. I hadn't ticked it off. Item 12. Just you take that, Nick. Governance Policy Review.
Yeah, just bear with me a second while I find the right page. If someone could help me on that.
Policy Review is on page 213.
Yeah. Thank you. Yeah, thank you, Chair. This report is to provide members with updated versions of a number of governance policies for commenting or noting as appropriate. It includes some policy updates which will be circulated to pension fund employers for further comment. So basically, most of the pension fund's governance policies are required to be formally updated every 3 years. That's what we've set in our business plan. The review is overdue for some policies, mainly because we were expecting an overarching review of local government pension scheme governance for over a year now, as a follow-on from work that had been carried out on behalf of the Scheme Advisory Board. However, there's no certainty about when those revised regulations or guidance on local government pension scheme governance will actually appear, and internal audit has recommended that the fund should update our, or at least approve our governance documents. So the following documents are attached to this report, and they're listed in paragraph 4.2, and they're obviously included as appendices to the report. Most of the changes that have been made to these documents have been fairly minor. The exception is the pensions administration strategy, which we've rewritten substantially to make it a shorter, hopefully more usable document. This is a document really for employers in the fund primarily. And we've also significantly included a charging policy. And this was, again, following an internal audit recommendation. They recommended that we should set out in what circumstances and how much we would charge employers if they don't comply with our administration strategy document. And the intention is only to levy charges as an absolute last resort. We would always seek to work with the employers to help them fulfill data exchange and any other requirements they have. So the next steps would be that the pensions administration strategy and the charging policy will be sent to employers for consultation and be brought back to the committee for approval should substantive changes be made following that consultation. And the other governance policies will take immediate effect subject to any comments there are from the committee. So
okay.
Chair.
Any comments on that? Yes, Councillor Beale. You're on mute.
Just a question, Chair, whether or not those changes, and specifically the one about the charging policy, has been shared with the employers in a you know, I don't know whether, for example, the finance people in Stockton Council have been approached.
Well,
I've not had a chance to check it.
Sorry, yeah. That's what they do. Once you agree to them, or you're happy for me to do that, that's what I'll do next. So I will be sharing these documents with all the employers. Well, actually, my colleagues at XPS will be sharing the documents with all the employers in the fund, including the finance people at the councils.
So are they being, if I may, are they being shared as this is the change in policy, or has it been shared in these are the proposed changes in policy? Do you have any comments?
It will be a consultation, so they'll have the opportunity to comment.
Thank you.
I gather then it would come back to us for sort of final approval.
Yeah.
Right. Okay. So are we happy? Any of the comments? Are we happy with that? That it goes forward to the next stage of consultation? All those in favour? I think everybody's nodding their head. I think, yep. Councillor Beale, yep. Councillor Hobson. Right. Well, I think that's fine, Nick. You've got the approval to go into the next stage. Thank you very much.
Thank you, Chair.
And now, the bit I nearly got right before, XPS Pension Administration Report.
Thank you, Chair. And good afternoon, everybody. This is the standard report that we usually present at this committee. So it goes through the normal items to pick up on a bit of the regulations and the consultations that have occurred in the last 3 to 6 months. There's been a consultation response from HM Treasury, and this is around the increase to the normal minimum pension age. So that's moving from age 55, where a member can voluntarily take their benefits, to 57. Legislation isn't in place yet, but it's an interesting one to keep our eye on as to how this change that affects the entire public sector and pension schemes more widely will be incorporated into the LGPS. And there's a note there, stronger nudge to pensions guidance consultation. So this is a DWP consultation regarding draft regs that would require pension schemes to nudge, as they say, pension scheme members into obtaining independent financial advice when making decisions on transferring benefits out. This is something that we already do and have done for a long time, but I think the DWP, along with the pensions regulator, are trying to standardise and really heighten the risks to be shown to scheme members where transferring benefits out, because a member can transfer a benefit out should they wish. There are certain checks that the administrator needs to do as a matter of course, but it's making sure that the member fully understands what they're doing, what they're giving up in the LGPS, and the risks to transferring benefits out of this environment to a private sector arrangement. And I think there'll be especially stringent checks that need to be considered when transferring benefits to an overseas pension scheme. The scheme return was completed on the 10th of November, so there was a note there to say that failing to submit a scheme return could result in a fine from the pensions regulator. So that scheme return was submitted, and Nick should have a copy of that to refer to. Moving on to membership, we can see that there's been an increase in Q2 on the active, deferred and the pensioner cohorts, which is encouraging as the additional active members obviously bring in more cash, and then the deferreds and the pensioners are increasing as well. So overall, the size of the fund membership continues to increase, which is encouraging. We've got member self-service statistics as we provide as a matter of course. Bit of a way of demonstrating the take-up on the different cohorts of members here. So we can see that still relatively low membership uptake on member self-serve, looking at 14.7% on the actives overall, less than 5% of deferreds, and just under 7% on the pensioners. We've spoken before about ways to encourage this, and just to reiterate on a couple of points, we now have a tried and tested means of writing to en masse scheme members, and that's all membership types to encourage them to come online. And we've made it as easy as we possibly can by adopting what we call a bulk activation key generation. So this is where we'd generate a unique ID number through the pension system, merge that into some crafted communications and send that to the member's home address. This would be, if we can do it, and this is something that we're speaking to Nick about, this will be the first time that they've ever really had a bespoke communication about online services, other than at the very start of member self-service, and that was around about 16 years ago. So although we do mention it in newsletters as often as we possibly can, and we always refer scheme members via the telephone, email system to encourage them to register online. Historically, as we all know, the take-up's been very, very low. So this is an exercise that we think will improve the take-up. And the other thing that we've just signed off on is some software, some animation software. So it's just been signed off this morning by XPS, and we've got some test animations that we've created already. One of the first things that we want to do is create an animation in which we'll publish on websites, and we can ask employers to send it out to members internally via intranets, look more locally. The first things that we're looking at doing is to encourage the registration of member self-service, to encourage the retention for the scheme member of their local government pension scheme membership, and also to explain about the annual and lifetime allowance. So we do expect that these will be quite snappy animations, probably 30 seconds to a minute long, that really dig into the salient points for the scheme member, things that they need to be mindful of, and obviously try and pick out the highlights. 30 seconds to a minute isn't a great deal of time, but it should give people in a different type of delivery means a flavour of what it's all about, and that's on any topic that we're going to cover with the animations. So that's an exciting addition to the communications piece that we hope will drive these numbers up. Moving across to additional work, the guaranteed minimum pension project that's been ongoing for a couple of years now. We expect by the end of this financial year to have completed the reconciliation of scheme member data. So this is making sure that the data within our pension system for the Teesside Pension Fund and the data that's held by HMRC is absolutely accurate. Now, there's been a couple of bumps in the road with this because we did get a data download from HMRC that allowed us to do this reconciliation work, but they then told us that the information that they had provided, and this is for every pension fund, not just Teesside, was actually incorrect, or some of it was incorrect. So there's now a manual process in place where we need to interrogate a GMP reconciliation website for the member queries. So it's taken a little bit more time than I think anyone would have liked, really. But we expect by the end of this financial year to have that reconciliation complete, and that will allow us to then move on to writing to scheme members to explain what GMP reconciliation and rectification is and how potentially it affects their benefits, because there could be some people who have underpayments on their account and some who have overpayments. And at XPS, we're speaking with Nick and more widely looking at this as a national exercise to see what the guidance is, what policy or what decisions can be adopted on a national basis in relation to things like overpayments. Does the fund recover the overpayment or not? Is there a threshold? But one thing we do have to do is to amend any pensions that are found to be incorrect due to the GMP work, so as that we're not continuing to overpay or underpay the scheme member. So it's quite an in-depth and complicated project, but we're hoping to see some significant movement on this in the next 3 or 4 months. On complaints, we've got none recorded for the period, and there's not additional IDRP cases to report to the committee today. There's a note there that retains the previous quarter's IDRP, and we had 2 that are ongoing and continue to be. One relates to a scheme employer quoting redundancy as a reason for leaving. So we paid out the requisite benefits to the member on that basis, but then the employer told us that it wasn't actually redundancy and that the reason for leaving should have simply been dismissal or voluntary resignation. It means the same thing as far as pensions is concerned. But what it doesn't mean is redundancy. But with redundancy, what the benefits that are paid to the member, where in this case she is over the age of 55, it wouldn't reduce the pension due to the fact that it's been taken early. So accrued benefits are paid in full and they're not actuarially reduced. So in a sense, she's been overpaid on this retrospective basis that the employer told us that she left. And this is going through dispute. I believe it's at IDRP stage 2 now. And we're pushing the employer to engage with the scheme member because they haven't done so as yet. They did promise to us that they would consult with her last week, but I'm yet to see anything that they've sent to her. We've encouraged them though to really start to engage with this member because it's been ongoing for a little while now. And there was another case where a member had not received inflationary increases, so this was an error, and that has been remedied with arrears plus interest paid to the scheme member. There are no new cases to the Pensions Ombudsman, and there's a note there to say that there's a case that has been with them for some time, and we're expecting a ruling shortly on the case for this. No High Court rulings and no breaches of data to report this time round. Common data remains very similar to as it's been reported in the past, so we've got a common data score here showing 3,187 fails across all the data items of common data which are set out in the report at 95.88%. And then the members with a multiple fail, so what this means is there are members with more than one fail on their record. For example, address. If we don't have the address data present, we likely won't have the postcode data either. So if you take out or if you compress the scoring, it actually shows a data score for unique individuals at 99.46%, which is really quite high. It's a good data score. On the conditional data, we've been reporting on this for some time now, that we've been testing against 7 of the 22 agreed criteria for conditional data. So it's not moved, and it's been quite frustrating that this hasn't moved. And I know we have committed, if not to this committee, then certainly to the pension board, that we would start to build 2 tests per month to get to the agreed 22 with SAB. What we're doing, we are committing to having everything completed by the end of March. Work is ongoing now with this. We're going to rebuild the initial 7 tests, and we're going to continue to build the other 15, and that's going to be done by no later than 31st of March. And as of, or from that date, we'll report on every conditional data item. And this is important for many reasons. Data accuracy being the first one, as it's the basis of what we do. Without good data, it becomes very, very difficult to perform effectively, and everything takes that much longer to do. But it also gives the confidence to the scheme members, to employers, and hopefully to the committee and to the board, that we're trying to improve the data as much as we can. And the start point for that is to test the data to see whether it's accurate or not. Obviously, we keep talking about pushing members to be able to see their benefits online. So 24 hours a day, 365 days of the year, a member could go online, and we want to be confident that when they go online, what they're going to see is a true reflection of their circumstances. And by building these tests robustly, and then where we do have fails, working on them to remedy them, it'll put XPS, the pension fund, and the scheme member in the best possible position. It will likely generate quite a lot of queries with the scheme employers, and this is to ensure that we catch up and make sure that all of the data is right. But not only do people go online and see this information, but with the McLeod legal challenge and the remedy work that's going to be carried out very soon with data collection, that's going to impact on the conditional data. And we've also got the Pensions Dashboard Programme. So this is the government's initiative where anyone that has any pension scheme in the country can go online and see an amalgam of all of their pension scheme benefits in one place. So ahead of that, we need to make sure that we've done as much data cleanse work as possible, so that the dashboard programme for a scheme member that has LGPS benefits with the Teesside Pension Fund is as accurate as it can possibly be. Okay, so moving on to customer service, we continue to send out a questionnaire with a retirement pack, and these results have been very consistent for the last few years that we've been doing this for, 4 or 5 years that we've been doing this for. I think the trend is that people, are happy with the retirement process, but any feedback that we do receive will be taken into consideration, whether it's good or bad feedback, for us to try and improve our process. We don't want to be left behind, and if there's an expectation from the scheme member that something should work markedly different to what it does, we can obviously do something about that very quickly. Okay, so moving through to the website, we've included some statistics there for November 2021. So that the usage of this site has dropped a little bit, maybe because of the spike in usage over the summer period where benefit statements are sent to members. So it's dropped off a little bit in October and November, but we're still at a little bit under 2,000 people, individuals using the site on a monthly basis. The interesting bit, I think, here is to see the top 5 search items. So annual reports, opt-outs, employer contributions, flexible retirement, and ill health are the top 5 search items that we see here. So opt-outs is one that I mentioned about the animations, whereby we're looking to help the fund retain as many people as possible by giving them the information that they need to be fully informed about the pension scheme. So with having this data, it would allow us to obviously to see in this case that there's an opt-out search request that's very popular, and we can put the animation in the pages that the opt-out search would find through browsers such or search engines such as Google, Bing, etc. So it's quite useful in that respect. We can also see on the browser usage that the use of Internet Explorer, which is no longer supported by Microsoft, has really declined a lot. And that's a trend that's been the same over the time that we've been using the analytic data on the website. And that's good because it means that the members are getting the best possible experience online, because this is optimized for Chrome, Safari, Edge, which is the successor of IE, and then the Samsung browser as well, which is a mobile browser. So there's quite a lot that you can read into those statistics, but it is all quite positive. Okay, moving on to employee liaison. With the pandemic and with Christmas on the horizon, the employee liaison activity is reduced a little bit, and this is where we're having health checks with the employers on a one-to-one basis. I've spoken to the guys on the team, and they're going to really ramp this up at the start of the new year. There's a lot to talk about with the employers. Nick mentioned the consultation documents that are going to be sent to them shortly, that you've just noted. So we'll be talking to them about the pension scheme, the benefits, the activities that we've been doing, and what they can help us to do to help the members. But we'll also talk about things like that with them as well. It gives an opportunity for every employer to speak with the administrators and build that relationship and really thrash out any issues that we have. So they're really useful, and they'll pick up, and what we'll include is a table of activity on the employer health checks in the new year, so you can see exactly how busy we've been. So there's quite a lot of work to do there. The next table on the report, page 14 of the individual report, shows the late payments. So these are payments that are made late by employers. We have 4 late payments in September and August. They were no more than 3 days late for any of them. So that's consistent with what we've seen since we've been reporting these late payments, which dates right back to April 2020. It's really not of that much concern. We still do have a couple of employers who don't use backs and submit this information and payment manually using checks, which is not great. But we do have a very wide range of employer types, from your local authorities, the university, and the colleges, to the very small, one-person employers. And they're not all set up the same. So we've got to, I think, continue to be flexible, but obviously keep an eye on where employers are making late payments. So moving on to annual benefit statements. By the 31st of August in any given year, we've got to supply an annual benefit statement to every active scheme member. So we've provided some analysis within this report of the number of active members at the year end on the system, which is 24,023. There were a number of those, so 1.92% or 462 weren't actually due a statement. And this is generally because they've left the scheme between the 31st of March and the 31st of August, which meant that there was a due number of 23,500 people. So of those, we produced a benefit statement for just over 22,000 people. So 1,536 didn't receive a statement, but should have. And the reason for this was what's called care pay. This was missing from the year-end file that we received from the employer. So either they've just not provided that information within the year-end file, or they've potentially left and don't have a care pay item in the year, in which case we should have had a leavers form from the employer but haven't. So we're undertaking a bit of a cleanup exercise to make sure that these 1,536 members are all looked at individually So this is a member by member lookup to see why we don't have care pay, why it isn't on the spreadsheet from the employer, and whether it should have been. If it should, then we'll produce the benefit statement, but if it shouldn't, we'll request the necessary leavers form details for them. We found that there's been a slight over quote on some of the benefit statements for this year, and this is to do with the program that runs the statements within our Altair system. So we're doing some analysis on this, and that is happening as we speak. And we're looking at the solutions to provide an updated statement to the scheme members that this affects. It doesn't overquote by a huge amount, and it could be argued that there isn't actually an overquote, but in the normal way that we do things, it is overquoting based on how we displayed this information last year. So we're looking at that to see what the impact is and what we can do to get these statements out to the affected members. On pension saving statements, this is another statutory document that we need to send to affected scheme members. And this year, by the 5th of October, which is the statutory deadline, we produced 99 pension saving statements across the entire fund. And these statements are to alert scheme members who have a pension input amount of over £40,000 in the year. They will have potentially a tax charge that they will need to settle with HMRC by the 31st of January 2022. So within the document that we send, we let them know whether they had an input which exceeded, in our case, we use 38,000 to try and inform scheme members in advance that they're approaching this limit. But we show them that they are around the breach limit, whether they have sufficient carry forward from previous years to offset that tax charge, and if they don't have sufficient carry forward, what they need to do to ensure that the necessary tax is declared on the pension input. There's a couple of ways that you can do this. One is you can dip into savings and pay the charge directly to HMRC, but these values can be quite high. So by far and away, the most popular way that we see members discharging their liabilities to HMRC is through a scheme pays election. So this is where we work out what the scheme pays debit would be from the pension, record that with HMRC, and an election is made by the member. And then when the pension comes into payment, eventually, that scheme pays debit would be deducted from the overall scheme pension that's paid. In terms of the performance, it's a good set of performance tables again over the last quarter, 6 months. There were one or two items where they slightly dipped below 100%, but I don't think really with that there's anything of concern. The main one that I can see is estimates of benefits, and this is where out of 125 cases, we didn't manage to get one of these done within the 10-day KPI. So it's one of 125 that we missed. And really, generally speaking, they are all completed within a day or two of the KPI limit. So I would suggest it's a healthy display on the performance from the team. And nothing of concern to note to the committee today, but happy to take any questions that you may have. And that concludes the report, Chair.
Thank you. Do we have any questions for Paul? William, you have a question, followed by Councillor Beale.
Yeah, I don't normally stray into administration, but I do note that 1,500 odd ABSs weren't issued by the 31st of August, and I believe that that is a breach, which may or may not have to be reported to the pension regulator. My question is, what process have you taken to decide whether or whether not it should be reported to the pension regulator?
Yeah, thank you, William. Whether or not it's reported to the regulator would be a matter for the scheme manager. So we've spoken with the scheme. what we would normally see with the value of this on the scheme members. Although it's not insignificant, the regulators' view that we've seen in the past is that they would recommend it to be noted in-house. And as long as we're looking at these to try and remedy any that don't have a benefit statement this year, and we can show what we're doing with that as long as it's recorded on an internal risk register, they wouldn't see it as a reportable event to them.
That may well be so. I'm not suggesting it should be reported. I'm just suggesting that somewhere we should actually have written down the reasons why the scheme manager chose not to report it. So maybe it's a question for Nick rather more than you then.
Yep, I can take that. Thank you. If that's all right, Chair. Yeah, you're absolutely right, William. And I'm waiting for a sort of more formal update, because what Paul set out here only relates to the active members. It doesn't give us a breakdown of the deferred, and I suspect there might be slightly more deferred members who weren't receiving their benefits because of the usual reason, which is we don't have their addresses. But there is a policy for reporting breaches, which is included within this this pack, which we can make sure we follow, and that will involve a decision around whether we should report it to the regulator, or if not, we should record it on the breaches log, which is what I'll pick up with Paul outside of this meeting.
Okay, thank you.
Okay, Councillor Beale.
Thank you, Chair. I just don't know whether there's been a typo in the membership movement chart on page 313. The numbers for quarter 2 are exactly the same as quarter 1, which is a hell of a coincidence.
Yeah, it is. I can double check that, Councillor Beale. Yeah, it seems odd that those numbers are exact, because as we know, there are movements day to day within the scheme. I mean, this information is derived from the system. I wonder whether the parameters for this chart have maybe been incorrect with the wrong quarter popped into the system there. So I can look at that and report back.
Thank you.
Okay, any other questions? If not, thanks, Paul, for the report, etc. Just one question. Presumably now it's going up to 56 as the state pension age rises over the next number of years. Presumably that will track that, so it'll go up to 57, 58, etc. as that goes. Is that correct?
I would think so, yeah. And it's what we normally see with these things is certain protections are in place. So depending on what the expectation of the scheme member would be, will depend on when they fall into these new bands, in the same way as the state pension age changes and people have certain protections against that from when they were born. There could well be protections put in place there for the older members who are closer to age 55 when the change is going to take effect, compared to those who might be decades away from age 55 when this comes into effect. But I think the government, with the current legal challenge that's going on around the protections, where members will move from the old final salary basis into the new career average pension schemes right across the public sector, the government will be very, very conscious that this is always subject to challenge, particularly on the grounds of age discrimination, which is a common theme in anything that they do change-wise. So, yeah, we'll expect it to have an impact, but exactly what impact remains to be seen at the moment.
Okay, thank you. If there's nothing else, thank you for your report. And the next item under this would be any other business under this part. Nick, do you have any other business for this?
No, Chair.
Okay. So we move on to 15, exclusion of press and public, to consider passing a resolution pursuant to section 100A, part 1 of the Local Government Act, excluding the press and public from the meeting during consideration of the following items, that if present there would be disclosure to them. Do we have a proposed that we exclude?
So move.
Okay, seconded. Seconded, thank you very much. All in favour? Thank you. So that is passed. We now will exclude press and public.
Can we just give Scott a minute to cut the
We
feed?
can.
Thank you.
Bear with me, Chair. I'll advise everyone when the stream's ended.
Thanks, Scott.